Prashant Khemka, founder of White Oak Capital Management, joins us in our studios. Prashant, thank you firstly for being in our studios and for coming from Singapore to India a day early. I'm taking a little bit of credit for that, for being on my show.
No, absolutely. Fair to take that credit. Thank you for having me here.
No, the pleasure is entirely ours. So, lots happened in the last 24, 36 hours. I know you don't look at it from a prism of what's happening day by day, but there's a lot of skepticism in the markets currently around the frenzy at the broader end of the spectrum, the mania of what's happening in the IPO space, not just SME, but the main board as well. And everybody talking about how there are telltale signs of this approaching an exuberance period. But at the same time, people say, yaar, Sara market exuberant nahi hai. My panwala is not giving me tips. Everybody is not in the same bus. So we are far away from the top. I would love to understand how you are looking at risk assets globally and India as well.
Certainly. I think the telltale signs that you're talking about, they're very much there. So if you compare, you've been in the market for long enough, so the environment is quite, it reminds you of 2017 time frame. That was the last time when SME IPOs were all listing at 100+% premiums and all, and also the huge, fundraises in IPOs and all. That was last time. Small and mid caps had a very rampant year in 2017 as well. Before that, maybe you had to go to 2007 when the environment was very similar, 2006, 2007. Yeah, so I think we are definitely, if there is some kind of a trend line, we're definitely on the other side of trend line, other side of the average. Now, this can continue for, it's not clear whether you're in 05, 06, 07. The big rally started in March 03. Exactly 17 years later, the big rally started in March 20 from the COVID bottom. Yeah. So it's not necessary that this would go on till 25, which is 5 years. It's not necessary, but it can go on longer as well, could be shorter as well. So that's the difficult part about, it's like a party. You are enjoying the party so much. You know already it's past the due time. Yes, at some point, as my boss would say, the cops would come, but nobody wants to leave because they are so enjoying the party, if you will. So it can go on for much longer, and you have to, tread cautiously, but you can't be out of it.
Yeah, the bullish argument might be more time is spent trying to wait for the correction than in the correction itself. So, are you of the belief, because it's difficult to time the top per se?
Impossible.
Right. So, are you cautious currently? Would you, given a choice on personal accounts or portfolios, sit on a bit of cash because of the exuberance currently, or are you still riding the party?
Yeah, certainly. So personally or for client accounts, I have never sat on cash. Over the several decades that personally I've invested in India or abroad in the US, so I've been fully invested at the top in 2000, at the top in 2008, at the top in 2017 and so on. But by the same token, I've also been fortunate to stay fully invested at the bottom in 2008 or 2009 actually. The bottom in 2003 and the bottoms that have come through. So I'm firmly of the opinion, what you said often my team members or clients, when they say it is very difficult to time or call the top or the bottom, I correct to say that it is not very difficult, it is impossible. Because something that is very difficult, it can be done. It's just very difficult. But calling the market is like calling a coin, a coin flip. And the odds are similar. You'll be right half the time, wrong half the time. And the amount of time you sit out is the return that you will lose if you were to aggregate over time. So we stay fully invested at all times, and so is the case right now as well.
Well, the coin flip argument of Prashant is similar to his argument when talking about macro. That Prashant usually says that trying to figure out the call on the markets using macro is like a coin flip as well. So I just remember that conversation that we've had in the past. Okay, so so it may be a stated policy, or you following that policy that you do not try to time the market, which is fine. But would you believe that the probability of the near term market performance being a bit more sedate is higher, or do you reckon that this uptick that we're seeing, the probability is higher for the markets to inch up higher from where we are currently?
So I think it's reasonable to expect. See, the safest thing to say is that volatility would be high. That's what all experts say, because that makes them sound smart. Yeah. So after a strong rally that we've seen over the last 12 months, it is unreasonable to extrapolate that we'll have similar returns, particularly in some of the smaller cap segments of the market. They'll have similar returns going forward as well. I think what's reasonable, at any point in time, it's reasonable, I think, from the Indian markets to expect a low double-digit return from the market. And same across large, mid, small in aggregate. In aggregate, markets are quite efficient. So the rally we've seen of about 20-odd% in the overall market and 40-odd% in mid and small, that could be very well justified if economic growth were to continue leading the world at this 7-8-odd%. Remember, in 03 to 07, 08 time frame, the earnings growth at aggregate market levels were 25%, and mid and small cap earnings growth were far higher than that. If I recollect correctly, were closer to 40% or so. So if we have very robust economic growth over the next few years, which all of us anecdotally seem to agree we would, it is very possible that you see high levels of earnings growth across market, and particularly so for mid and small. And in that case, the current valuations would also turn out to be attractive when looking backwards at some point in future. It's just not possible to bet on those. It can happen, it may not happen. Yeah, so that's why I say it's fair to stay fully invested at all times, but expectation going forward should be low double-digit return.
But to be fair, the broader end of the spectrum, since the COVID lows, the earnings run rate at the broader end has been pretty strong.
Absolutely.
And I've heard you mention 03 to 08 period twice already in this 7-8 minute conversation. Is this reminiscent of what happened back then? Is the cycle looking similar?
So at that time it was stronger, at least anecdotally what I remember. It was off the top of my head, and also the numbers were, as I was saying, right now the growth over the last 3 years has been 20-odd% in the aggregate market level. At that time it was over a 5-year period 25%. I don't remember first few 3 years were stronger or not. So it was somewhat strong. And we started at that time at lower levels than in March 2020, both from a broader economic and corporate earnings perspective, but also the market multiple. 2003 was a multi-decade lows, particularly for small and mid cap. In terms of valuation, multiples would have been for the aggregate market around 10 times or so in March 2003, whereas in March 20, it would have been mid-teens or so.
Right. Now, Prashant, at our launch event, your colleague Ashish was at the launch event, and he made this interesting point about how you bet on foreign inflows coming into India at the very start of you setting up White Oak. I mean, it was expensive maybe to set up structures in foreign jurisdictions, but you did that because you preempted that India will see flows. Now we're seeing asset manager after asset manager talking that 6 years out. Today, I think we put out something that Natixis Asia economist has put out about how they are very constructive on the structural story of India. PM Modi gave this interview to FT as well. When you think about managing these large sums of money that you do as well, do you believe this cycle is very long? And I'll come to specifics as well, but I'm just trying to understand, when you're thinking about asset management currently, do you reckon that the probability of making double-digit returns, high, low, whatever, over the next 6-7 years is high? And therefore, even if people miss out on the early pop, let's say, it is still wise to make fresh investments or stay invested in India, because you miss out on backdated returns eventually if you try to worry about the 3, 5, 7% currently.
Certainly. No, very true. I have seen over last many years, many investors globally, if I were to talk about, perennially worrying about Indian valuations. We've in fact written a newsletter. One of the 2 newsletters we've written about is about the Indian premium. Yeah. So I think the biggest mistake investors make is comparing India's P multiple with rest of the world, be it China, which is the favorite comparable, for investors, or be it emerging markets average or global average and so on. I think India has a couple of attributes that in combination provide a unique combination, if you will. So India is the largest democracy globally as well as in emerging markets. It's a well-functioning democracy. It is one of the fastest growing economy. So this combination, and plus corporate governance, despite all that anybody says, having invested across EM as well as developed world, certainly I'm confident in saying corporate governance in aggregate in India is superior or second to none in the emerging market space. So if you combine these three, and the aspect about democracy also is related to governance at a national level. In authoritarian regimes, the respect for property rights is very minimal. There's no recourse to law because the authority itself is law. Yeah. So whom would you appeal against them? In India, it's very routine for people in India or global corporates like Vodafone sued the government and still could expect to do business in India. Yeah. How many emerging market countries, and think of authoritarian countries, and how many authoritarian countries can you sue the government and still expect to do business in the country? Certainly can't happen in China. Obviously now Russia is no longer in EM basket, but can't happen in Russia and so on. So that is very valuable. Yeah, people used to often complain that in India, building national highways and all is such an arduous process. You announce a project and then it takes decades to complete it because one small farmer can sue the government and hold up the process. Whereas in China, the Three Gorges Dam displaced millions of people, and within a whatever short number of years, such a massive feat was accomplished. To me, I would always challenge the on the other side to the client that, you know, isn't that worrisome that a country, I mean, in not just particularly China, if a country does not respect the rights of a small farmer, would it respect rights of foreign investors?
Sure.
How much confidence can you have in that? And if India as a jurisdiction respects rights of small farmers, then it's quite possible it would respect rights of foreign investors as well.
Sure.
And ultimately, equity is nothing but a contractual right to perpetual cash flows of the company. And those rights are valuable only if those rights have sanctity and would be upheld in the jurisdiction. And hence India commands a much higher multiple globally, and this aspect has, I think, increasingly being recognized consciously or subconsciously after the events of last 3 to 5 years at the global stage, including what happened in Russia, including what's happening in China during COVID, but also post-COVID, and so on and so forth. And hence the multiple expansion, relative multiple expansion, has gotten further entrenched, and I believe you would see a massive influx over the coming year unless there's some untoward incident between now and then. You would see a strong influx of foreign money in the country.
Got it. So Prashant, tell me, and I would love to get into the micro as well, but just one macro question, because you have a great pulse on foreign investors and the money that is coming in your conversations, whether or not they invest now or they invest 6 months or 12 months down the line through you or through some other asset managers, but are different kind of large global investors looking at India now relative to what it would have been, say, maybe 2 years ago or 5 years ago? And give us some color about what is this.
No, absolutely. The lot of new investors globally are looking at India for the first time. A lot of investors who've been looking at India for a long time are at a point where they want to action the decision. So few things, if you have to, understand why. First, we've already talked about, everyone knows India is growing and democracy and the economy is now headed towards 5 trillion and so on. All those things are very well the contributory reasons, but also understand that in emerging markets index, MSCI EM index, till about 10 years ago when I started managing the EM portfolios for the first time at my prior firm, China was north of 30% in the benchmark, and with the changes that MSCI was going to undertake by including the domestic A share market as well, it was headed towards 40%. Yeah. So for decision makers, asset allocators who are looking ahead, they're already saying China's 40% of emerging markets have to have allocation. Yeah, pension plans, sovereign wealth funds, and so on. They would have dedicated SMAs or allocations to China. 40% is being huge. Within EM context and even within global equity index, China was, I think, around mid-single digits or thereabouts. In contrast, India in 2013 was smaller than Brazil in the benchmark index. Some of it is our own doing because we have so many restrictions, like in banking sector, 74% is the cap. It has a certain unforeseen or more complicated impact that the largest bank, which is HDFC Bank, is not in the index. Yeah, that impacts hugely the weight of India in these indices. But leave that aside, or be that as it may, India's weight was around 5%, 5 to 6% at that time. So think of China close to 40% in investors' mindset, and India at 5 to 6%, smaller than Brazil.
Yeah.
You can easily ignore at that point in time having a separate allocation for India. Yeah, because first you have to deal with China, then Brazil, and then maybe come to India. Where we stand today, China is now 25, 26% of the benchmark, down from 40, and what was expected to be 40, and India has grown from 5% to close to 17%. So the math has suddenly gone from China being 6, 7 times larger to India to now only 1.5 times India in the benchmark index. And hence, and the direction and the pace at which these are moving, India has rapidly risen on the totem pole, if you will. And I would say it is now top priority ahead of China for most institutions.
But not just passive. What I meant was people who are not looking at the index necessarily, but coming to managers like you.
No, this is active.
This
very
is
much
active.
active.
Okay, you're talking about active. Sorry, excuse me.
Because ultimately, see, any asset allocator is measured against something.
Yeah, okay. So the benchmark is that.
So the benchmark ultimately gets into effect.
Okay. So a very new set of investors are starting to look at India in conversations with you as well?
Yes, absolutely. New set of investors, past set of investors who were invested in India till, let's say, 2013, 14. Because what's happened also, Neeraj, is over the last 10 years, there's a growing disenchantment with emerging markets in general. Because emerging markets have not delivered anything. Over the last 10 years, the returns are zero. And developed markets have done very well. US in particular, yeah. So a lot of investors who were invested either in EM or in single country, like India, back in, who all started investing during the BRIC phenomenon of 2003, 4, 5, 6, 7, but they all exited after 2011, 12, 13, 14. Now those are also coming back.
Sure. Okay.
And India is kind of the entry point for those. Many who had only invested in China as a separate, so EM, a lot of investors who, it's like, in India there are various types of vegetarians. One is complete vegan, one who eat egg, or one who eat milk and then eat eggs and then eat chicken and so on and so forth. So there are investors also of various types, and now India has become particularly attractive, which was not the case earlier.
Got it. So when investors are asking you about, and you've already told me that India will trade at a premium. So I'm trying to now understand, when you're trying to design these portfolios, really from a long-term perspective, and viewers, some of the viewers who heard you through our conversations know that you have a valuation metric, which is the OPCO and the FinCo. So that is well established. But therefore, when you're trying to figure out where is it that you would want to take advantage via your portfolios for the next 3, 5, 7 years, what is the design of the portfolios currently, keeping in mind that you have a healthy mix of long-term global investors, but at the same time you run a very active mutual fund business as well, which is very retail. So what's the portfolio like?
Certainly. So I think the basic approach of the firm is very, very similar. So the MF team headed by Ramesh Mantri runs it. The broad contours are very similar as to how we run the global assets, which is that broader market investment opportunities we look for. We don't have any strong preferences, though since alpha opportunities are larger in mid and small cap space, we always have higher allocation in mid and small cap space, which remains today as well. Yeah, though in MF space, obviously you have large cap fund, flexi cap fund, all those are different, so they cater to those guidelines and principles. But if I talk more broadly for the offshore funds, it is, think of it as a flexi cap product with roughly 40% in mid and small and 60% in large, and then as across sectors. Historically, it's always been the case, and today even more so, I would say, that the team finds some outstanding opportunities in financials. In large cap, mid cap, small cap, across the market cap spectrum, financials haven't participated to that extent in the rally this year. I think that has made, and when we look at financials relative to other sectors, on valuations and prospects, when we look at Indian financials relative to where the similar financials trade across the world in emerging markets or developed, I think at this point we are finding most compelling opportunities in financials, and that is the biggest segment in the portfolio of exposure, followed by, I would say, consumption-oriented opportunities and technology, IT services, as well as some of the new age companies which obviously went through a very volatile phase over the last 2 years, and after a torrid or horrible 22, they've stabilized to a greater degree, both on the business front, more particularly in the business front, as the competitive dynamics have evolved with the, with free money not being available anymore, and competition hence in check.
While these remain the principal bets, have you been enthused by the advent of newer sectors in the last few years, last 2-3 years? So you mentioned tech-enabled businesses as one, but there is the resurgence of defense, the comeback, if you can call it, of PSUs, and just suddenly, EMS, railways, all of them have come to the fore. Have these excited you? Have you been able to do the OpCo-Finco model for these as well?
Yes, no, absolutely. So OpCo-Finco is basically an enhanced DCF. Wherever you can apply DCF, you can apply OpCo-Finco. In fact, we've even applied to financials where DCF cannot or isn't usually applied. But that aside, so yes, when I mentioned not to mischaracterize the team's views or how it manifests in portfolios, so financials, consumption, technology, when I mentioned, these are the largest chunks. In the benchmark also, financials 25-30%, so it's likely to always be also the largest in the portfolio. So financials, say about 25 to 35% in the portfolio. Consumption, when you put together discretionary and staples, can be 20-odd% in the portfolio, 15-20%. Technology, double-digit % as well. But then there's a whole slew. So if you add these together, 30, 20, 10 is 60% of the portfolio.
Got it.
The remaining 40% would be in a whole host of other areas, including defense, cement, PSUs. You mentioned there'll be a whole host of those names in the portfolio.
Where would you be contrarian, Prashant? One, where largest contrarian bet, if you will. Why so? And if being contrarian, I do not know, but if being contrarian is, if it has hurt you in the recent past, what is the rationale for holding on to some of these bets? I have no idea about where you are contrarian, but I'm asking.
So I would say over the last 2-3 years, and continues to be the case here, the biggest contrarian position in the portfolio, I would say over the last 5-6 years, has been our exposure or investment in IT services.
Okay.
Yeah, particularly mid-cap IT. So like I was telling, financials, we find strong opportunities across large, mid, small. In IT, we've always found a lot more attractive opportunities in mid-cap space, mid as well as small. So going back to when we started in 2017, August 2017, White Oak, we had fairly large investments in IT, particularly mid-cap IT. That played tremendously well for the portfolios in 18, 19, 20, 21, some years more so than other years. And then 22 was a horrendous year for IT services as the US demand slowed down and all. Because of that, these names are down 20, 30, 40% in a year where the market did very well. Now in 23, while the stock prices have recovered for many of the mid-cap IT as a sector overall hasn't done better than the market, but hasn't done terribly like 22. But mid-caps have done very well, and we are at a point where skepticism, despite these mid-cap names or overall IT not having done so poorly, the skepticism in the market is still very high. This is always how it happens. Be it at the market level, individual sector levels or whatever, the stocks could do well, in fact often do well in the face of such skepticism. We believe that looking forward from here, the opportunities over a longer time frame, and to your question of, why did you stick to them and all that, because by the time you realize, US is going to slow down, the stocks are already down 30%. Yeah. So stocks slow down. The stocks started collapsing late 21 onwards, at a point in time when the demand environment was very robust and forecasted to remain robust. So we are, historically, if I look back at my investing career, most of the money has been made through stock-specific stock selection, and not by calling these trends at a sectoral level or a macro level, which is what I call in the coin flip category. Sometimes you go right, other times you go horrendously wrong. Like post-COVID, a lot of people took a call that the sector to be in going forward is pharmaceutical, because everyone would be popping pills for the rest of their lives, but it didn't turn out to be that way. It's been a dog of a sector after the first few weeks of COVID. So we never make these top-down calls, and that was the case with IT also. We didn't make that top-down call. We believe Indian IT services would continue to, at an aggregate level, gain market share globally. Within that, the best execution machines in Indian IT services would gain market share relative to the overall industry. And the business model has shown over the years, over the decades, to have generated huge value creators. And several of the small cap, when we invested 6 years ago, there were small caps names. Small cap names have already become mid caps or large caps by now, and that's the expectation going forward.
Proponents of the IT-enabled businesses, the tech platforms, say that globally these businesses are a large portion of the indices. India, we don't have so. At some point of time, they will become large participants of the index as well, and therefore the runway for growth is very large and very long. Would you be of the same thought? What is the idea of staying in these businesses?
So let's say the conclusion is right, though the rationale for investment may not exactly be that because this would become large components of the index and that's why we should be investing in them. They'll become large components of index because they'll end up being highly profitable cash flow generating companies.
Of course.
So the reason to rationale for investing is more identify opportunity, and it's not a generic statement. A lot of them would go out of business, like has happened everywhere in the world, but the successful ones would end up generating huge amounts of cash flows, and their valuations in hindsight would look like peanuts compared to what they would eventually become. And like with any other sector in any other part of the world, our job is to try and look for those opportunities. Yes, we'll be wrong many a times, but then hopefully right at other times if we are doing our job correctly.
So there are different segments here because it's a very diverse sector. What within this landscape do you like more? Is it food delivery? Is it payments? Is it fintech? What do you like?
See, there isn't a going in, there isn't a preconceived viewpoint that we like this segment better than the other. You have to evaluate basis, what is the competitive dynamic here? Obviously, what is the TAM, total opportunity size, and how have these businesses evolved in other markets, in China, in Korea, in US, and so on? How is that different, though? Not everything is comparable to these. How is it different in India? And in that Indian context, how is competitive intensity evolving now? And what are the strengths of the company under consideration? What are the sustainable advantages, competitive advantages of the company under consideration in the context of that competitive intensity? Many times it might just be the sheer execution capability. When you look at some of the NBFCs in the Indian market, I can't name names, but NBFC is a cutthroat competitive market. Over the last dozen years or 2 dozen years, a couple of decades, some NBFCs have done phenomenally well. And other NBFCs, we don't remember their names because they had to be bailed out or have gone under. What differentiated them is the execution capability and not the rosiness or the opportunity in NBFC space.
Yeah, but having said that, we are just out of time completely, but I would just love to understand, because I can't get into names. I'm just trying to understand that the reasons, background reasons notwithstanding, where is it that you found favor? In which segment within the internet space? Is it a fintech? Is it delivery? Is it payments? What is it?
So I would say it's not, I can say what it is not. So it's not fintech. It's, we haven't found great opportunities in fintech space or in payment space and all, but otherwise there are several opportunities outside of there. And don't remember, it's not just companies that got listed in a year or two. There have been some of these companies in the new age space that have been listed for a decade or two.
Okay, point well taken. Okay, but we are out of time completely on this show. But Prashant, take a moment to thank you for joining in today in our studios. Great having you, and look forward to have you more often.
My pleasure, Neeraj. Always a pleasure to see you.
Thank you so much.
Thank you all.